Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Zach Haptonstall. He is the Chief Executive Officer and co-founder of Rise48 Equity and Rise48 Communities. Rise48 Equity is a retail syndication multifamily investment company with offices in Phoenix, Arizona, and Dallas, Texas. Rise48 Equity has completed over $1.99 billion in total transactions and purchased 44 assets, 7,000 plus units since 2019. They currently have $1.55 billion in assets under management in Phoenix and in Dallas, and they have completed 11 full cycle dispositions and returned capital to investors. The company has 220 plus full-time employees. Rise48 Communities is vertically integrated property management company that manages all the assets for Rise48. So Zach, welcome to the show.
Yeah, thanks so much, Keith. Really appreciate you having us on. Looking forward to providing some value here for the listeners. So excited to be here.
Yeah, I can't wait to dive into it. Huge portfolio, huge amount of assets under management. And so really kind of want to get to that. But I always like to start, Zach, with really where you grew up and kind of your personal journey as far as getting into real estate.
Yeah, absolutely, Keith. Yeah. So, probably like a lot of people, I would assume most of your listeners, I just kind of grew up in like a lower middle class family, no real estate connections, no rich uncle or, real estate people like that. And I was just kind of taught like everybody, you go to school, get good grades, go to college, get a good job and then retire, right? And sail off into the sunset. So that's kind of, the path that I was on. And, I wanted to be a football player initially. And so I had a Division II football scholarship, played a little bit of, small school college football. Then I realized I wasn't, good enough, big enough to go to the NFL. So the next best thing was I wanted to be a sports reporter. And I got a journalism degree. So I was a live news anchor, sports reporter for Arizona PBS for a short time, which was cool at first, Keith, and kind of the adrenaline of being on live TV. And then I quickly realized that when it's your job, it's not the same as being a fan and you hardly make any money. It was crazy. Like I was making more money doing like, what you consider entry-level jobs than what I was doing in journals. Like, man, this sucks. I don't want to do this. And so I graduated in my early 20s. I had a bunch of student debt because I was, having to take on loans. I didn't have any like support from my family or anything. And so I was working full-time nights and weekends to pay for school. And so, I was delivering like medical equipment at that time, just like an odd job I got, decided not to pursue journalism. I went into healthcare marketing. So I decided, okay, I don't want to do journalism. I need to make money to pay off this student debt. I had been reading, the Dave Ramsey books, trying to get to like, kill my debt and try to just get established financially because I didn't want to have all this debt. It didn't feel good. So I knew that through healthcare marketing, I could potentially make good money. So I started working for a hospice organization of all things, just kind of a random, occupation I fell into. Mm-hmm. And I would just wake up in the morning and drive all around Phoenix and walk in cold to like hospitals, doctors' offices, assisted livings and, meet with physicians and nurses and social workers, and they had somebody who needed hospice, end of life care, they call me, and I'm the first person to meet with the family, educate and get a sign up. So long story short, Keith, it's kind of sounds weird, but hospice is a very competitive and lucrative private business industry. It's all regulated and funded by Medicare, the federal government. And so Phoenix is like the number one market for hospice in the country because there's a lot of seniors here. It's very competitive. So, I was fortunate at a young age to do really well and really kind of dominate this space, and so by the time I'm 23, I'm making like 150K a year. I bought my first house. I killed all my debt. I started, getting my MBA at night, doing night school. I was working full time. I finished that when I was 24, paid for it cash. And so, by the time I'm 26, I'm making 200K plus a year. I have no debt. I'm financially established, but I was miserable because, I was working, tons of hours on call 7 days a week, doing something I really wasn't passionate about. It was just a way to get financially established. And I kind of had achieved that, but I felt like I had like some type of golden handcuffs, like a lot of people probably do.
Right.
And I just felt so unsatisfied. But then society and everybody's telling you, you should be grateful. You're making more money than all these other people. And I was just like, you know what? My goal is not to be like other people. I have my own ambitions and my own goals. And so I didn't know anything about real estate, Keith. I just knew that I was, unhappy. I was trading all my time for money. And so January of 2018, I started to learn a little bit about real estate. Like I read Rich Dad, Poor Dad, but I literally knew nobody. Okay. I didn't have any connections, no family, nobody, no mentor. I just was like, you know what? I'm miserable doing this. I want to figure out how can I create passive income or residual income where I'm not having to constantly grind each month to get paid, because that's how sales is, right? It's like, what have you done for me lately?
Exactly.
The first of the month, everything resets, right? And I was just getting so burnt out on that mindset, even though, I was competitive and good at it. And so January 2018, I had no plan. I resigned, and I had some sweat equity I had earned in this company. So I cashed that out, and I had been relentlessly saving for like 4 or 5 years, following the Dave Ramsey plan, just a single guy being very frugal. So between my savings and this little, bump of cash I got from selling this equity, I had almost 300K of cash, which I felt like I was rich. Like I thought that was like a fortune when I was like 26, 27. And my plan was, okay, I don't know what I'm going to do, but I don't have any time to figure it out because I have this job that I hate. And so let me get out of this and live off of savings to figure out how to create passive income or money through real estate. Okay. And that's what I did. So I literally had no plan, knew nobody. I didn't even know what multifamily syndication was at that time. That was not the plan. I'd never heard of it. Didn't know the concept. I was looking at flipping homes initially. And then I realized that's transactional. It's what I was just basically doing, getting commissions, flipping homes, same thing. Then I started reading books, listening to podcasts, kind of like yours, Keith, and trying to learn about this, educate myself. I learned about mobile home parks and passive cash flow. I tried to buy my own mobile home park in Phoenix. I cold called over 90 different mobile home park owners. And my goal, I had learned about like seller carry financing from books and podcasts.
Right.
And so I was trying to negotiate a seller carry because I had this chunk of cash. And the whole time, Keith, I was thinking of, okay, I have this cash, which I've just, busted my butt to get to this point. And I was starting to burn through the cash. And I was like, how can I make my cash go as far as possible? How can I get into something? And as I started to like learn how to underwrite and do the analysis, I was like, man, I'll be lucky if I buy a mobile home park, a small one, and it like the cash flow barely covers my expenses, right? And so through this process, long story short, I won't go on. I'll let you ask any questions or, progress us through the conversation. But long story short, I learned about the concept of syndication, which I think through a podcast, which was really intriguing. And the light bulb kind of went off because I kept trying to figure out, how do I make this chunk of cash go as far as possible? When I realized I can use my time, energy, and effort and leverage other people's money, and I can earn sweat equity, and it's a win-win because they're leveraging my time and effort. That's when it clicked. And I realized that I could scale much larger, because even if I was going to buy my own mobile home park with my own cash, okay, let's say best case scenario, I do that. I make $2,000 to $3,000 a month cash flow. Then what do? That's not really financial freedom. That's not, and then I'm broke. I have no more cash, right? So I was like, when I learned about the ability to syndicate, I was like, that's what I want to do. You know what I mean? That's how I can kind of scale and really achieve my goals. So there's obviously a lot of things that happen after that, but that's kind of how I grew up and how I got to that point. it was really just a lot of self-teaching and trying to seek out knowledge.
Okay. And that's very interesting. Quite a bit of it. Everything from the hospice. That's kind of my W-2 isn't hospice, but I'm in the death care industry with funeral and cremation and cemetery. So
Okay.
very
Yeah,
familiar
all right.
with hospice with the connections there. But and then same thing, mobile home parks. That's kind of our focus.
Nice.
Good stuff there. So what did you do, as far as your first, you've gotten turned on to the idea of syndication and, this looks like a
Yeah.
solution for being able to make that $300,000 go a lot further. Where did you go from there?
Yeah, good question, Keith. So, at first I was kind of jumping around. Like a lot of people, I'm trying to like absorb all this stuff about quote unquote real estate. And I learned very quickly how expansive and overwhelming quote unquote real estate is, right? There's so many different components. And I was like, oh, there's self-storage, there's mobile home parks, there's apartments. This looks good. This looks good. You get like the shiny object syndrome.
For sure.
And whenever I would start to like dig in, so I at first kind of learned about mobile home parks, and that was intriguing, Keith, because people are like, those are a cash cow. If you want cash flow, you go mobile home parks. As I started to like dig into these deals, I was like, these cap rates are so compressed. They're like the same as multifamily at the time. The cash flow wasn't what I thought. So I got discouraged and I'm like, you know what? I missed the boat. Everybody already found out about mobile home parks. It's saturated. It's too competitive. I got to go to the next thing. And then multifamily, oh, these things don't pencil. It's discouraging. I missed the boat. And so I kept jumping around before finally I realized, you know what? Anything that makes money or is a good vehicle is going to be super competitive. And it's not like I'm going to discover something new. I need to choose one and stay focused and dig deep and just stay laser focused. Stop, screwing around and getting distracted. So that's when I decided multifamily was I wanted to do, and I want to syndicate. Okay. So I started reading books. I started going to meetups. And I started, building a team, so to speak, which is I learned from books. Like I need to have a property management company. I need to have an attorney. I need to have an insurance agent, all these different pieces. So I started cold calling these different people I would find online, meeting with them. That helped me to learn more. Then I started going to conferences, and I met my first partner, Robert, at a conference. And, my net worth at the time, Keith, was my cash. Okay. So I didn't have net worth or liquidity to sign on any of these loans to qualify. So my first partner I met, Robert, I met him at a conference in Dallas in the summer of 2018. And, his net worth was like a few $1,000,000, right? And so, they weren't like super wealthy, but, his wife's a physician and, they were, doing well. And he was trying to get into this as well. And he had a background in construction. So it's like, okay, this is my construction guy / balance sheet guy, because I was trying to quickly absorb and learn all the different facets and components of owning multifamily and building a team. And I tried to identify, what do I have? Like, what does Zach bring to the table? What are my strengths? And then what are my weaknesses? And what do I need to go find? So I kind of viewed myself as like the architect of this, the point guard, if you will, where it's my job to orchestrate putting this deal together. And I'm going to put together a team and I'm going to find the pieces to make this happen. Okay. And kind of be the leader of the team, so to speak. So Robert was the first person. Month after month goes by, Keith, and I'm just burning through cash, making no progress. It was extremely discouraging, frankly, because I'd wake up in the morning and I'm like, what the hell do I do today? It's like before I would wake up and I was in this industry where, I'm quote unquote the man, where I'm an elite competitor dominating my competition. I know what I'm supposed to do every week. I know what defines success. I have goals to hit. Well, when you're an entrepreneur and you don't have a job or anybody to hold you accountable, and it's such an overwhelming feat when I don't have anybody to go to, these numbers are big, these apartments are big. I'm like, how can I possibly get into this? And meanwhile, I'm burning through all this cash that I had just relentlessly worked to save. It was very discouraging. And there were a lot of days where I just kind of mentally and emotionally quit. And then, a day or two go by and I'm like, well, I'll call these brokers again. It's like you can only call the broker so many times before you're just annoying them and nothing changed. But long story short, 10 months into this, so October of 2018, I find a deal. It's 36 units in Central Phoenix, and it actually penciled, based on the underwriting. I probably underwrote like 30 plus deals at that time.
Yeah.
And this deal actually made sense. And so, I put in an offer, and I was terrified to put in an offer. I'd only put in like a few offers. This offer gets accepted. And I'm like, oh crap, they actually accepted this. Like that was terrifying. Cause it's like, now I have to do something, right? Like I have to actually move or do something. Otherwise the broker, and I was so terrified of these brokers. I was like intimidated by them. I felt like I didn't belong. And I was like, if I don't do something, the broker's going to think I'm a joke and I'm going to get blacklisted and I'm going to ruin my whole real estate career. So, I talked to Robert into it. He didn't even want to do it. I was like, this is the deal. We got to do it. We got to push through the fear. It was a $3.4 million purchase price, 36 units. We had to raise about $1.4 million of equity. In hindsight, it was like a crappy 1960s deal that was kind of falling apart. But, to us, it was a gem because we wanted to get into the game. And so, I put up 25K of earnest money. Robert put up 25K of earnest money. We had 30 days, and each day goes by and we're getting close to that 30 days, Keith. And, I'm going out to all the people I had talked to the last, several months who said they're interested. Like, hey, I got a deal now. Like, you want to invest? And most of them don't even get back to me. They're like, oh no, sorry, it's not a good time. Or let me know when you get, some more experience. And so I tried to syndicate the deal. Nobody wanted to invest with us. So I'm like scrambling, and I'm getting up to that 30-day mark. And I had already blown through a lot of cash. Okay. I was going to conferences, joining mentorship programs, had no income coming in. And so I was like, hey, I can't lose this 25K, but I got to get a deal done. And so I said, screw it. I told Robert, we got to just push through. So we let the 30 days pass. My 25K goes non-refundable. So does his. And we got to find the 1.4 million. So at the time I had about 165K left. Okay. And I decided I'm putting 160 in the deal. I told Robert, I said, I'm all in. We're going to figure it out. I'm all in. I'm putting in 160 because I wanted other people to know that I'm all in, so that I could, get them to believe and convince them. So I talked Robert to putting in 275. We met our third business partner. I met Bikron, who's now our CFO at Rise48. I met him at a conference while we were in escrow, and he was trying to get into it. I talked him into putting 150. And then I met a lady at a conference, and she had sold like a 12-unit deal and had a 1031 exchange for about 650K. And we brought her in. So long story short, it was a long, grueling 4-month escrow, Keith. But we bootstrapped this thing together, and we put together the 1.4 million, and we got that thing closed. So our first deal closed 14 months after I quit the job, just focused on this full time. And that was February of 2019. So that was huge for me because it kind of got the monkey off my back, and I would go to these conferences, or you even go to like, networking events or family events, and people say, oh, what do you do? I say, oh, well, I'm a real estate investor because I don't have a job. I don't make any money.
Right.
And then they're like, oh, what do you own? I didn't own anything. I felt like a loser, honestly.
Right.
Like I lost all my confidence, my self-identity. So now that I had a deal, I was like, it was kind of like vindication. And it gave me so much confidence and momentum to then start moving forward from there. So that was kind of the first deal. And obviously things have happened since then, but that's how we kind of got into it, from coming from no background or anything like that.
Wow. So as far as the capital that you raised, it sounds like most of it were people coming in almost as general partners. Is that accurate?
Yeah, we did a TIC structure.
Okay.
That's correct. We did a tenant in common or a TIC structure. So there were no LPs. There was no GP-LP split. It's basically a handful of us put our money in, and we're all operating this deal together. And obviously some of us had more active roles or, certain roles than others, but everybody played a part in that. That's right.
Okay. And because you set it up as a TIC, it allowed the one lady to roll her 1041 into the deal because of that structure. Otherwise, that wouldn't quite have worked.
Exactly why. That's why we did the TIC. You're right, Keith. So I had never even heard of a TIC. I didn't even know what the hell it was. And she's the one who said, hey, I got this 1031 exchange. Do you want to do a tenant in common or a TIC structure? And I said, sure. Like, what's a TIC structure? Like, I didn't know what it was. I had never heard of it. So I learned about that too. So we did that TIC, you're right, because we had a 1031. And then we had other people, that were coming in bringing money. So we created a few different entities. And we had people in these different entities that were all tenants in common owning this deal.
Wow. That's pretty neat. That's cool how it all came together. I mean, it sounds obviously like a chore, but I could see how that would do that with you, right? As far as, here you're pursuing something, and now this kind of gives you the ability, at least for yourself from an identity standpoint, to say, yeah, I am a real estate investor. We're part of this deal, and it's a full-blown apartment.
Yep.
So
it's huge. It's huge. I mean, you've been to a lot of conferences, I'm sure, Keith. And when you go to these conferences, there's like thousands of people across the country that are trying to get into this and say they're in it. But the number of people that have actually done one deal is very slim, right? So it's like almost, I felt like I was kind of like, quote unquote, in the club now. Like I'm on the side that's actually done a deal.
Right.
You know what I mean? So I don't feel like I'm just talking, and so that was a big relief and kind of just gave me vindication to keep going forward.
Yeah. And obviously you kept going forward because you guys have almost 1.55 billion dollars under management. And so tell me a little bit about where it went from there. Are you still partners with your original buddy whose wife is a physician?
Yeah. Yeah. Good question, Keith. Yeah. So yeah, I am. So Robert and Bikram, we have all done all of our deals together. The three of us, we are still partners to this day. We've done every deal together. And we, a couple of years later would formally create Rise48 Equity and, have our roles within our firm. Prior to that, we all kind of had our own little brand, right? And we were, I was like ZH Multifamily. Bikram was Bright Investors. Robert had his own marketing shell. But yeah, as we started getting going, and so, yeah, I mean, after the first deal, I was kind of all in. Long story short, I had no cash left. So what I did is I sold my house and I used that money for earnest money to tie up the next deal. So we then syndicated the next deal. It was another long, grueling 4-month escrow. And honestly, like at least the first 8 to 10 deals were super stressful. And it was like bootstrapping every deal because raising money is so hard. I think a lot of people think it's easy. It's not. Even if you have a great deal, a great market, if you don't have track record, it becomes difficult. So it was all about, building. So I can tell you, if I look back, Keith, the first 3 years, 2018, 2019, 2020, we bought 6 total deals in 3 years from when I started,
Wow.
Which was maybe about, 60 million or so of assets. And we made no money. I didn't make any money until the end of 2020 when we sold our first deal. But near the end of 2020, after 3 years of laser focus on this, things started to click where we started selling our first deals. And so we were personally getting flushed with liquidity. And when we would sell a deal, it gives us track record. So now we've gone full cycle and we can show investors, hey, we bought this deal, we executed the plan and we sold it and we exceeded our projected returns. And after we started selling deals, we're getting flooded with investor referrals. So like our current investors, the existing investors would refer their colleagues, friends, and family. And then people that are just looking to get into this, Googling passive income in Phoenix or whatever, they start reaching out to us. We start forming relationships with new people. So we started selling deals. We had personal liquidity. We had new investors. We had proven our track record with local brokers. And I've managed all the broker relationships. So most of our deals have been sourced completely off market. And in every major market, like right now we're in Phoenix and Dallas, there's like 5 to 7 individuals who control 90% of the inventory. They're like the gatekeepers. And so in Phoenix, we now started to source off-market deal flow. We were getting deals before anybody else saw them. And then we started charging acquisition fees. The first 4 or 5 deals, we did not charge an acquisition fee because we want to kind of prove the concept to investors. Well, it is very industry standard and it's how you generate revenue.
Yeah.
And so in the second half of 2020, all these things come together. We decided to form Rise48, make it an S Corp so that the 3 of us could actually take salaries to pay our bills. So we were, just trying to survive. I was in credit card debt at that point even, until we sold the first deal. We started taking salaries. March of 2020, when we opened up an office, we hired our first employee. So in the first 3 years, we bought 6 deals, about 60 something million. Mm-hmm. In 2021 alone, when all these things started to click at the same time, we purchased 16 deals, 560 million in 12 calendar months.
Wow.
In 2022, we purchased another 16 deals, 860 million in 12 calendar months.
That's
right. And this year, we've purchased 8 deals so far. It's slower because of the economy, interest rates. We'll finish with 10 deals. I don't know, around 300 million, maybe something like that. And so basically from 2021 till now, we started to generate a lot of revenue. We reinvest all that money back in the company to build out infrastructure. So we started our own property management company. We started a construction management company. We now have over 200 plus full-time W-2 employees on full healthcare benefits. So all of the profits we've been making, we reinvest in the company. We invest in infrastructure. We buy all our materials directly wholesale from an overseas manufacturer, and we control our own supply chain. So we've created a model where we can rinse and repeat the same thing over and over. And we're very boring, Keith. We're very vanilla. Mm-hmm. We just kind of stay in our lane. We stay in our box. We only buy like 1980s or newer value add multifamily in Phoenix and Dallas. And we do the exact same business plan on every single deal. So it's the same materials, the same renovation scope, the same underwriting model. And we just kind of rinse and repeat. So doing that, staying focused gave us the ability to concentrate and build scale. because our first 40 deals we bought were all in Phoenix within like 30, 40 minutes of each other. Okay. So it's like a cookie cutter process, rinse and repeat over and over. And investors like that because it gives them confidence that, hey, these guys specialize in this. So if I want to invest in value add multifamily in Phoenix, these guys are only focused on that. And we were getting results, right? So we started selling deals and getting good returns. We started doing 1031 exchanges for our investors. So they're making a ton of money and they're 1031 exchanging it. And then we recently, about a year ago now, 12 months ago, we expanded to Dallas and did the exact same thing. So, my wife and I bought a second home in Dallas. We opened up an office in downtown Dallas. We now have over 40 plus employees there. Just yesterday we closed our 6th deal in Dallas. So now we've got like 1,600 units. And so it's the exact same model, just in another market. And so that's kind of been how we've been able to scale, is to, not get distracted with any other asset class. We took, 4 or 5 years to even add a second market because we wanted to make sure that all of our systems and processes and our investor reporting, all that stuff was really, built out so that when we did add a second market, we could expand responsibly and get the same, kind of results. And so that's kind of been the whole structure and the thinking here.
Yeah, it's pretty incredible story, and it's neat that you've just have basically two cities that you're focused on. That's unusual in this space for sure. And it sounds like most of it in Phoenix, and Phoenix really just happened just because that's where you were located at the time, right?
Yeah. Good question. It's a combination of, I was lucky. I didn't even realize this till I got into real estate, that I was lucky to live in one of the top multifamily markets in the country. Right. And so, the biggest thing is because I live in Phoenix and, local boots on the ground, et cetera, et cetera. It's good to invest in your own backyard, but also it happened to be a really strong market and, among the leaders in the country for the key fundamentals that we look for, like job growth, population growth, rent growth, things like that. So Phoenix initially, and then recently expanded to Dallas for the same reasons. Both markets are tops in the country for fundamentals we look at. They're landlord friendly, business friendly. And so we want to be very, intentional and specific of what type of markets we're looking at to execute this business plan.
Okay. And that's neat that you're vertically integrated as well. And it sounds like more than just the property management with the materials and the construction. Can you talk a little bit more about how you've set up? Are we talking countertops, or what are we talking about that you're getting specifically from kind of this wholesale deal?
Yeah, great question, Keith. And I'll give you a little bit of context, and I'll go into that. So first off, I'll say we never planned to have our own property management or construction management company. Okay, I had always learned from like listening to the books and the podcasts, you buy an apartment building, you slap a third-party management company on there, and then we sit back and collect the cash, right? That's what I thought this was, passive income. Well, I can tell everybody, if you want to be an operator, there's nothing passive about it. It's an absolute grind. And as we started to scale to get to like 2,000 units, we started to realize, hey, this third-party management thing is not working. And not to say it's not good or can't work for other people, but like for us, for what we wanted to do, we needed to have full control over staffing and everything like that. So even before that point, before we even thought about property management, we were using third-party property management. And typically you'll rely on the property management company to do all of the construction management, which means that they are sourcing, bidding out, and managing subcontractors to execute your renovations, right? Staying on schedule, on budget. Well, that wasn't happening. We were trying to rely on these third-party PMs and quickly realized these guys are not staying on schedule. They're not staying on budget. I'm having to go out to properties and chew out vendors and make sure that they're doing what they're supposed to do. And so before we ever started property management, we started our own construction management. One of our very first hires was a construction manager. And so basically what that means is that it doesn't mean we're doing the in-unit labor. It means that our W-2 employee is sourcing, bidding out, and managing the labor on site. Okay, so first we started basically bringing in construction management, and then we realized that we're using these third-party contractors, and they are exposed and vulnerable to macro supply chain shifts, right? If they're all going to Home Depot or Lowe's, and Home Depot and Lowe's ran out of stainless steel appliances, then I can't get what I need. So we then started realizing we need to figure out the supply chain component. And so we talked to our local staff, like our asset manager at the time, and I told her, I said, hey, talk to everybody you know in this industry and find out how we can buy materials from overseas. And so she found a contact where they produce everything overseas. They manufacture all the stuff inside of our unit. And so once we took supply chain in-house, and I'll answer your question, what that means, what they provide for us,
Mm-hmm.
we were able to do a much higher level interior scope because we were buying things, at fixed rates in bulk. And so basically our supplier, they've got overseas manufacturing plants. They manufacture everything inside of our unit, which includes vinyl plank flooring, quartz countertops, cabinet boxes. We buy our stainless steel appliances through them. They use a third party, but we buy the appliances through them. All of the hardware, ceiling fans, light switches, every little thing you can imagine, the blinds for the windows. We give them a forecast, typically 90 days out. We say, hey, we need materials for X amount of units. They manufacture it. They ship it overseas. They've got 2 warehouses in the US. One is in Phoenix, one is in Dallas, which is a big reason we went to Dallas.
Mm-hmm.
And then they've got 24-hour crews inside their warehouse. They have a day crew and a night crew. And I've toured, both warehouses with them, with the owner. And they're building custom kits for our units. And so when I go do a due diligence for a new property, my supplier comes out to the property and walks and takes measurements of every single floor plan. So they have measurements for the small 1-bedroom, the large 1-bedroom, the 2-bedroom. And so they know the exact amount of vinyl plank flooring. They know the measurements of the quartz countertops. They know the cabinet boxes, et cetera. They manufacture it, put together kits in the warehouse. Then they have box trucks where they will deliver the materials and drop like 3 to 4 pallets inside the unit. Our construction guys come in, open it up, and everything is there. And they crank through it. So all the vinyl plank flooring has already been cut. You've got the quartz countertops have already been prefabricated for those measurements for that unit. All the cabinet boxes are already assembled. Our guys just hang them. Okay. And then we start popping on hardware, ceiling fans. So it's like a supply chain or an assembly line, I should say. Kind of think of like, Ford Motor Company. It's like an assembly line where, okay, I got 5 units. The flooring guys come in, bang out all the flooring the next couple days. Okay. Then painting comes in and everything is right there. So we basically solved construction management supply chain first. And then we realized, hey, we need to have control over our on-site leasing, our on-site manager, our maintenance. Then we brought property management in-house. And so from my perspective, this is my opinion, if you're doing value add multifamily, I think construction management is a lot more critical than property management. Property management is still very important because when we had construction management in-house, when we were using third-party management, they're always clashing and there's always communication issues. It's like the construction team is saying, hey, I got this unit ready by X date. The leasing agent needs to be pre-leasing to coordinate the timing for the new tenant, and vice versa. The leasing agent's saying, hey, I need to know when that unit's ready. And then there's delays. So, we brought property management in-house then. And honestly, construction management is easier to start from my perspective. Property management is a pain in the ass, Keith. Okay. It's very operationally intensive. For us, it's worth it. And we're very glad we did it, especially now that the market has softened, in 2023. So it is a big commitment. When we started the PM company, we invested about $800K of our own personal cash, took about 10 months to break even because you're having to float salaries, get everything built out. But now it is profitable, it's doing well. But you don't start a property management company to make money. Property management is a crappy business model, frankly, because it's a low profit margin. We do it to have control, to get better results so that we get better returns for investors. And when they get good returns and they're happy, well, our high profit margin business is Rise48 Equity, the investment company. So anyways, I know that was a long-winded response, but that's kind of how we evolved. We did not plan to start these companies. It was out of necessity. And we realized in order to scale, we have to adapt. And so that's kind of what we've done there.
That's incredible. Very, very interesting. And on the appliances, you mentioned that you get those, I guess, through somebody that they work with. Are you getting those also at a kind of a wholesale price as well?
Yeah, exactly. So before we did this, Keith, we were doing what everybody pretty much does, which is like lipstick on a pig. Mm-hmm. We were resurfacing the Formica countertops. We were painting the original cabinets. We were doing black appliances. Since we took supply chain in-house like this and buying it in bulk, it's the same cost for us to do quartz countertops as Formica. It's the same cost to do stainless steel as black appliances. Sometimes it's actually cheaper for us to just rip out the cabinet box and put a brand new box or shaker door instead of trying to repair the original box and paint it. So basically we're getting, and the same with appliances, because we're buying it in bulk and we're giving them forecasts, we're getting significant discounts there because we're giving them volume. And Same thing goes for labor. Okay. So we use third-party construction companies to do the in-unit labor, even though my guys are supervising and walking units 40 hours a week, making sure they're staying on schedule, on budget. Previously, with most construction companies, what you'll find is that they make the bulk of their margin on materials. Okay. So they're buying materials and they're marking it up and building it into their overall cost that they're charging you. Well, what we told all these guys when we transitioned, we said, hey, we're buying the materials. Now you're using our materials. And if you don't like it, we're going to fire you. We're going to use somebody else. We don't care. But we said, we want to be fair to you. We just need to hit our budgets, and our budgets are reasonable. And with our supplier, we have a fixed dollar amount per unit for the lifetime of that deal. So if I buy a new deal today, we have a contract with the supplier saying, I'm going to pay you X amount flat per unit. I don't care if it's a 1-bedroom, a 2-bedroom, a 3-bedroom. I'm paying this flat dollar amount. So they'll make more money on other types of unit types than others. Mm-hmm. And then we went to our construction companies and we signed contracts with them, said, hey, I'm going to pay you a flat dollar amount per unit for labor. And you might make more money on, the studio than you would on a 2-bedroom. I don't care how it breaks out. This is how we're going to do it. And so we're actually paying them a little bit more in labor than they were making before, because they're using our materials. So we said, listen, I don't care what your margin is, what you were charging. Tell me where you need to be all in. You're using my materials, and I'll pay you that as long as it hits my budget, right? And it's a contract for the lifetime of that project. So in 2 years from now, if labor has gone up, I don't care. We have a contract, and I'm paying you flat dollar amount per unit. And the supplier and the construction companies, they all agree to this because we're giving them the consistent volume. Okay, so it makes sense for them. And we have leverage there. So if somebody doesn't hit our budget, we just say, okay, you're fired. We're going to use somebody else. And they'll say, wait. No, we'll make it work because we know we're going to give them consistent volume. And so that's what's allowed us to, stay consistent. I mean, just this year, Keith, we've renovated from January through September of 2023. We've renovated 1,700 units. And, wow. We're on average below our budget, and we're exceeding our pro forma rents by $16 a unit. That's net of organic rent growth assumptions. And organic rent growth in Phoenix is -4%. So we're actually still exceeding our pro forma rents by renovating. If we weren't renovating, your rents are actually coming down because there's negative organic rent growth. So, the plan is effective. We're forcing the appreciation, and it's all because of the infrastructure where we have the supplies, we have fixed costs, we have the labor, we have a lot of bandwidth, to crank renovations.
And on the, so you said that the contracts are for the life of the project. How long are those typically, as far as turning an entire apartment complex? What's the length of the contracts that you?
Yeah, great question, Keith. Great question. So, we are typically projecting to renovate all of the units over the first 24 months. Okay. So we don't empty out the property. If it's like a 200 unit property, you're going to do roughly, 10 units a month. So you just take the number of units divided by 24, and that's what we're averaging. It's never the same amount because basically these are all 12-month leases, right, for all these apartment buildings. And so how it works when we take over a property, we look at the rent roll, which shows us every single unit. When was that lease signed? When does it expire? What rent are they paying right now? We build out a schedule. So let's say on a certain property, we say, okay, we are not going to renovate more than a max of 10 units a month because we don't want to create too much vacancy. We still need these deals to cash flow. So we can't just empty them out, renovate everything, and lease them up. It's a fine line, right? It's like a balancing act. And so let's say in month 1, I have 15 units that have expiring leases, meaning that their lease was signed 12 months ago and now it's expiring. Well, the first 10, I'm going to do what's called non-renew them. And so in Arizona and Texas, we have the right to non-renew. It's not an eviction, but we can tell the tenant, hey, your lease is expiring. We're sorry, we're not renewing you. You have to leave. You have to move out somewhere else.
Right.
So they move out somewhere else. We immediately demo the unit, renovate it, and lease it up. And we typically are right now in Phoenix, we're down to 21-day average. Our guys are doing a really good job.
Yeah.
That used to be like 40, 45 days. I think in Texas, we're getting down to like 27, 28 days right now. So like within 30 days or so, we've renovated that unit and then we're leasing up to a new tenant at a higher rent. And we're doing multiple units at a time coming out in batches. Okay. So each month we're incrementally moving some people out, demoing, renovating, moving new people in at a higher rent, increasing the NOI, increasing the value of the asset. Now in that example, I said 15 units are expiring. We only want to non-renew 10. We don't want to create too much vacancy. The other 5 units, we'll renew them. We'll say, hey, your lease is expiring. We're going to renew you, but we're going to increase your rent like 50 to $100 because that's what the market is for all the other units nearby that are not renovated. It's called burning off loss to lease. And if they get upset, and we've shopped all these comps, Keith, for every single deal we ever make an offer on, we've already shopped the comps. So we know what rents in that immediate submarket are being achieved from our competitors for non-renovated units and renovated units. Okay, so it's not like we just make these numbers up. We make sure that they're conservative and it's in line so people will actually pay it. So when we tell people we'll renew you, but we're going to increase your rent, if they get upset, what typically always happens, they're going to go drive around and they're going to realize, oh, wow, nothing's cheaper. And we already know that because we've already shopped the comps.
Yeah.
And they typically end up staying because if they move, they're going to pay the same rent anyways, except they're going to pay first and last month's rent at the new place, security deposit, moving costs, et cetera. Right. So every single month, we're basically on these properties, we're moving some people out, renovating, leasing up at a much higher rent. We're renewing some people, moving the rent up a little bit. And for the ones that we're renewing, if it makes sense 12 months later, once that lease expires to renovate it, that's when we'll renovate it. And we're not like jerks. We try to always accommodate people. So like if there's somebody we're going to non-renew, we say, hey, we have to renovate this unit. We're non-renewing you. And if they want to pay more for a renovated unit and we have another one that we can transfer them to, we'll do that. And we try to accommodate as best we can. It doesn't always work out. But so every single month, we're just kind of incrementally, renovating and pushing up those rents while still keeping the deal at least 80-85% occupied, through that renovation process.
Okay. No, that's a smart way to do it for sure. And so when you're renovating or when you're renewing the leases on, say, the folks that you've let them know that you're going to have to increase a little bit, are you going a full 12 months on that? Or are you doing shorter terms so they come due?
Yeah. Good question, Keith. Good question. It depends on the deal. It's a good question. I mean, we typically are doing 12 months, but let's say like right now, for example, that's actually a good question because right now we just entered Q4, right? And so typically Q4 is a slow leasing season because of the holidays. So we're actually slowing down renovations across the portfolio in Q4 because we don't want to force too much vacancy because the leasing will not keep up. So we slow down renovations, and the peak season is kind of like, February through August for us to be trying to crank more renovations. And so on some of these leases right now, depending on the deal, we actually are renewing people at a 6-month lease because we want them to expire like around March so I can get them out and then renovate it and crank it to a higher rent, right? So it kind of depends on the deal. We look at, when these leases are renewing, how many have we already renovated? And then it depends on market conditions too. So yeah, we kind of play it by ear. But in general, most of the time we're doing 12-month leases and then, 6-month leases sometimes if we want to renovate that based on the seasonality of what's going to come up soon.
Okay. And as far as new deals that you're looking at, you mentioned, working through brokers, but you also had mentioned about, kind of going and finding off-market deals. Are you still able to find some off-market deals? And do you have something in-house that you're utilizing to try to, market directly to them?
Yeah, good question, Keith. So I can tell you every deal that we buy is through a broker. Okay. So when I say off-market deals, it's from a broker. So, I know a lot of people want to do like, direct mailers, cold calling. And I think it depends on the space and the size that you're in.
Right.
For what we do, I think it's a complete waste of time because like we're focused only on 100 plus unit multifamily deals. And so these are all pretty much sophisticated sellers. And we've even bought deals from like a true, like we just got a deal under contract. We're going to close it end of November here from like a true mom and pop owner family. But even they're using a broker because it's like a 200 unit deal. And so basically we don't try to waste time with that. I try to create relationships with these brokers and just, gain their trust and say, hey, I'm not going to retrade. And when we do make an offer, it's been very thoughtful. We've fully underwritten the deal. We've shopped the comps. We've sized the debt. We've gotten property tax, insurance projections. And so it is a pure volume game, Keith. I mean, I can tell you that at the time of this recording, we're recording this like mid-October 23. Since November of 22, so about almost 12 months now, in Dallas, we've underwritten nearly 240 different deals in the last 12 months, and only 8 of those have penciled. Meaning only 8 of them have actually, we can get to the price the seller is asking, which is about a 3% hit rate. Okay, so it's a true needle in a haystack. And so even if it's off market from a broker doesn't mean it's a good deal. it just means they don't want to take it to the market. But we have relationships with these brokers where they're constantly, I'm calling these guys like almost every week. And we've got an acquisitions team now too. I like to be the primary point person because the brokers like to know they're talking to a decision maker.
Mm-hmm.
Most of our competitors are large institutions like private equity firms, hedge funds, and they'll have multiple layers of employees, like an acquisitions guy, right? So like an acquisitions guy can tell the broker, hey, we're going to make an offer on this deal. Well, ultimately, the decision maker has to fly out, see the deal, and they could blow it up.
Mm-hmm.
For us, we're kind of unique in the sense that if I tell a broker we're making an offer, they know that at Rise48, we use our own personal cash for earnest money. We raise all the money internally from our investors. So we have 100% control, 100% autonomy. I'm not doing a joint venture with some private equity company that calls the shots and has the control. We have the control. We launch a deal to our investors and they trust us and they invest. And then we at Rise48, the three of us, we're signing on the loan. So I have no third parties. I have no masters. We're 100% autonomous. And that gives us a big advantage because the brokers know that, we're 46 or 46. Every time we got under contract, we've closed. Okay. So 46 times 100% conversion rate so far. And that's through tough times. That's through COVID. That's through interest rate hikes last year. That's through, this year has been tough. We've had some tough closings, but we grind it out and always find a way. And so when you can establish credibility and track record with the brokers, especially this year, this has always been kind of the case, but especially this year, they're not always looking for highest price. They're looking for highest probability of execution.
Right.
Okay. Because people fall out of these deals all the time. And so, that's kind of the advantage that you can get. And it's an unfair advantage. It really is, because these brokers, they're going to push the deal to buyers that they know can perform and that they know and like, right? So there's nothing illegal or immoral about it. It's a competitive advantage. It's like, okay, I've got a relationship with this broker at CBRE. He knows I can perform. He's going to bring me the deal. I'm going to see it before anybody else sees it. And if I turn it down, maybe he brings it to another few groups that he likes. And if they don't like it, then he'll bring it to the market, right? And people can, start to bid on it, things like that. And so, we're getting, the first look or one of the first looks of a small group of people on a lot of these deals in Phoenix and Dallas, just because, they know that we can perform. And so everything we've done has been through brokers. And it just depends on what your space is. I think, mobile home parks is a little more fragmented, I know, depending on the market. So it makes more sense to go directly to sellers. I know that's the case, but for what we do, and if you're doing smaller multifamily, it can make more sense to go to brokers, but
a little bit more mom and pop stuff.
Exactly, more mom and pops. Most of our sellers are institutions,
right?
So they're going through a formal process.
Zach, how about the lending environment right now? Have you seen changes over the last 12 months? And in kind of what's your general sense as to, if you have seen changes, what specifically have you seen different over the last couple deals that you've done?
Yeah, good question. And so, we've done a combination of Freddie Mac agency loans. We've done like debt fund bridge loans from like publicly traded REITs. And so we know kind of the pros and the cons. I'll say last year, Q2 and Q3, the debt funds, the REITs were pretty much completely on the sidelines. So, it was only really agency, Freddie Mac, Fannie Mae were kind of the only game in town, really across the country. And then the debt funds started to come back in Q4 of last year. And then this year, they've been active. There are a lot of them that are still completely on the sidelines, but, we've had multiple lenders on each deal that are bringing term sheets to us. And most of them are repeat lenders. And it's because we're executing their business plan. So like the way it works, if you're going to take a bridge loan, is that basically the whole idea is that they are going to loan you dollars to renovate the unit, execute a business plan, because they know you're going to increase the value, then pay their loan off, right? And so how it works, I have to front the cash on our end. We have to front the cash to buy the materials, pay the vendors, complete the work. Then we submit complex CapEx draws to the lender that shows them, all the invoices that we hit the budget, we executed the plan, we hit the projected rent, then they reimburse us through a CapEx draw for those dollars. And so because we've been effective at executing the plan, and frankly, most groups across the country have not. Okay. There's a lot of like value add groups who can't actually renovate units. You'd be surprised. And, the cap rate compression, organic rent growth has kind of covered up a lot of operational blemishes the last several years. And the organic rent growth has made us look smart too, right? No doubt. We've been benefactors of it like everybody, but I think we've been able to really build out infrastructure to truly, execute the plan and add the value, increase the NOI. And the lenders like that. And so we have not had an issue getting loans on these deals. We've always had, a handful of groups that are kind of bidding for it. And a lot of them are repeat lenders though. And we like to do repeat lenders because, I have seen this year that these lenders are getting more stringent and they're tightening up because lenders now, this is just happening in the last, 8 weeks or so, they're starting to get burned. So now as we're entering Q4 of 2023, we're now starting to hear about, I just talked to somebody last week, there's like, deals are starting to get foreclosed on. Okay. Because the interest rate pressure has really caught up to people. There's lenders now that are losing money. There's deals that are selling where the owner has no choice but to sell the deal because they've got, an interest rate cap about to expire or a loan about to mature. And the values have dipped so significantly in the short term because of interest rates that they have to get out of that deal. And, we bought a deal this year where the investors in the seller's deal got completely wiped out. We bought the deal for just over the loan amount that they bought it for. So we bought it for significantly less than what they bought it for just 2 years ago, and all their equity is gone. And so those are the things that we're seeing. And so, this is a very good time to be a buyer and be opportunistic because we're getting deals at least 20, 30% discount from what they've been trading at the last couple of years. It's not a good time to be a seller. So we've been telling investors, we're not selling any deals all year.
Yeah.
So we haven't sold a deal since July of 2022. Like we sold 5 deals the first half of 22, and we were hitting home runs on those. And then obviously the interest rates people started to see the writing on the wall and value started to drop, cap rates start going up. And so we're like, okay, we're not going to sell any deals. I don't want to give a buyer a discount just to sell in the short term. Right. And so the entire market has shifted. Whereas, before it was a seller's market and it was a borrower's market, meaning that borrowers had leverage because there was a ton of lenders that wanted to put out money. So borrowers could pick and choose and negotiate terms. Well, now it's a buyer's market and it's a lender's market because there's fewer lenders out there. They're being more selective with who they'll actually work with because some of them are getting burned and they're making their loan documents more stringent because they need to protect themselves going forward. Because you got to remember that the lenders are the biggest investors in all these deals, right? And none of them saw this coming. Okay, the biggest institutions in the world did not see the interest rate hikes coming. And so otherwise they wouldn't have put out all these loans. They put out billions and billions of dollars worth of floating rate multifamily loans the last few years. And so they're all kind of adjusting and, trying to figure this out and extend loans out. So anyways, that's kind of what we're seeing, as we sit here today.
Okay. No, that's very, very interesting. And I knew you'd have a good take on it just because of the sheer volume that you guys do. So that's awesome to hear. Well, you've really, Zach, built an amazing business. And I really enjoyed hearing your story today. How can people find out more about you, about Rise48, and if they want to invest?
Yeah, thanks so much, Keith. Really appreciate you having us on here. It was a lot of fun. And so, yeah, if you want to learn about our investments or what we're doing, you can actually set up a call with me on my calendar. And so you just go to our website, rise48equity.com, RISE48equity.com. And there's actually like a section you can set up a call with me whenever you're free. You can email me, Zach, Z-A-C-H at rise48equity.com. And we can, email or get on a call, and we'll look forward to talking to anybody.
Great. And I've got 2 more questions if you have just a minute. I know we're running a little bit long on time, but it's been fun.
So no rush.
One question I ask everybody is just, if you were just starting out your investment career, if you're talking to somebody who is just starting out their investment journey, what advice would you give them?
Yeah, good question. I would say that you need to try to focus in and dial in what it is that you want to do and concentrate on, because it's easy to get overwhelmed and have that shiny object syndrome, which happened to me and I think happens to a lot of people. So you need to dial it in and say, okay, this is the niche that I believe in, and I'm going to be the best in this niche. It's kind of like the cliche, you don't want to be a jack of all trades and a master of none. Mm-hmm. And so that's kind of what we've tried to do, is we want to be elite and dominate our competition in value add multifamily in these 2 markets. I couldn't tell you about, mobile home parks. You go to Keith if you want to invest in mobile home parks. Couldn't tell you about self-storage. So that's one thing, is just try to really refine it and just stay consistent, because you're going to feel like a failure. You're going to have to go through adversity, and it's kind of just you have to outlast and push through that. And then the other thing I would say is that don't take crap from anybody. Like, don't listen to anybody who tells you can't do it. Because when I was trying to do this, I had even my own family questioning what I was doing. They're like, you're making $200K plus a year. Like, why would you leave that to do this? Like, what are you even doing every day? And you're going to have doubters, haters, critics. And it's very common. And it could be people that are your friends and family, and they may either be concerned about you and create doubt in your own mind, or it's people that you think are your friends who are jealous or insecure that you are pushing your comfort zone and doing big things or trying to do big things that they would never do or feel comfortable doing. So you have to have like a lone wolf mindset and a warrior mindset and not listen to all this outside noise. Because I remember going through that initially when we hadn't achieved anything. And now when we start to grow and we're fortunate to have a little bit of success, then you get critics who criticize you for growing too much. It's the same thing. And now we have to deal with fighting the media, making stuff up about us. And there's all these different components that you will go through. So just remember, regardless of what stage you're in, people aren't always going to agree with what you're doing, but as long as you believe in it and you just keep grinding. I always tell people, Keith, this is kind of my last point, is that, somebody who's doubting you, they're not the one that has to put the work in to achieve your goals. You're the one that's going to put the work in. Right. So who are they to tell you what you can or can't do? And why would you listen to them? Right? Because you're the one that has to put the work in, and you're the one that's going to make it happen either way. So don't let those people, impact you. Because I remember in that first year, I would talk to people who I was trying to seek out mentors. I was literally trying to seek out mentorship. People were successful. And one guy literally told me, oh, you can't do that. That's way too big. You need to focus on like buying a single family house. And it crushed me because I believed him. And then I realized, screw this guy. I'm not going to listen to him. I mean, just because he doesn't think I can do it doesn't mean I can't do it. And so you can't let these people discourage you, because it can be very, powerful.
Yeah, for sure. I think that's tremendous advice. One more question that I ask every guest is just a book recommendation. It doesn't have to be real estate, but whether it be real estate mindset or just a good book.
Yeah. Good question. Yeah. I read a lot of audiobooks like on the weekends and when I'm working out, kind of reflect. And so, one book I listen to over and over, almost every weekend, I listen to different sections, it's called Winning by Tim Grovers. So he was the personal trainer for Kobe Bryant and Michael Jordan. And he wrote another book prior to that, Relentless. I'd recommend you read Relentless first, then Winning. And it just kind of talks about that relentless, warrior mindset that like Kobe and Michael Jordan had. And I think you can apply that to your business, because you're going to get to the point where you feel like you have all this adversity, and there's different, it's like it's a warrior mindset to push through the adversity and keep going. So I think those books really resonate with me, and I think people would enjoy those.
Yeah, very good books. Both of them I have listened to on audio as well. So, well, Zach, I know it.
Yeah, Keith.
It took us a little bit of time to finally get together, but I'll tell you, brother, it was well worth it. Just an amazing story, and super inspirational for myself as well. So I know it is for the audience.
Yeah, no, thanks so much, Keith. Really appreciate you being patient with me and getting us on the show and the opportunity. And yeah, happy to connect with anybody if I can ever help.
All right. We'll call the show. Thanks, Zach.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.